remember when I lost my mind. There was something so pleasant about that place. Even your emotions have an echo in so much space. And when you're out there without care, yeah, I was out of touch. But it wasn't because I didn't know enough. I just knew too much. Does that make me crazy? Does that make me crazy? Does that make me crazy? Possibly.
Hey, it's Delay, and this is episode 340 of the Orange Pill Investor, and I'm feeling a little crazy, bewildered. I can't stop thinking about the preferred stock, trying to understand it. So if you're here for understanding, you might not get it. What's up, Howard? Um, you might just be witnessing me flailing around confused, trying to figure out what in the hell is going on, trying to game theory it. But before I get into that, I'm just going to take a look at the market because I'm going to strike while we're kind of up. I wish I had gotten in here at around 10. It looked like the market seems to tank around 10 a.m. Like we get a little push, and then I don't know if they uh, if there's just selling pressure every time we try to go up, or if the algorithms or the I don't know if the ATM gets turned on harder at like 10 after the market figures out what it's doing. But yeah, like 4 out of the last 5 days, we'd get some, little pumps before 10 o'clock, and then it would just kind of dip a little bit through the lunch period. And it's just a little weird thing that I kind of noticed. So I didn't quite strike while the iron was hot this morning, but I wanted to highlight a little something about theta because I've talked about the 45 days to expiration theta decay curve, and there's a little bit of like 2 to 3 weeks sweet spot starting at around 45 days. And it's not that theta starts to taper off as we get under 24 days to expiration, it's that gamma risk begins to increase. So you can kind of take advantage of the increases in theta before gamma starts to play havoc with the options prices. And so if you look at, I was like, oh, okay, the price pumped to like 350. I was like, let me see if I could, just jump in, sell like a 1 days to expiration covered call. And when I was looking at it, I could get like $700 or $800, but it doesn't really matter the price. It still all works itself out. So I can get $620, basically, let me just go down to at the money. So 345, right? One strike above at the money. And I can get about double 1% of the underlying. So 1% would be move the decimal place over 2 places. Easy math, 345. Double that would be 690. So I can get a little bit about 2% return on capital for like 1.5 trading days. Not quite 2. If this was 2 trading days multiplied out for 5 trading days, that would be 10% return on capital for the week, which is insane. So I'm probably going to put at least one on just for the hell of it. So it's a little bit, theta starts to act kind of crazy. Because if you look at this, theta is 3, which makes sense because that's not quite half of the options value. So 3 out of the $7 is going to decay today and then tomorrow, a little bit more than half of this will be left. And if there weren't kind of like diminishing returns, this 2% in 1.5 trading days, well, let's just say 2 trading days. Sorry, I think I did my math backwards a little bit. So, yeah, 2% for 2 trading days, prorated out for 5 would be 5% for the week, not 10. Sorry. But if I can get $750 for 2 trading days, I should be able to get 2.5 times that for 5. And that would be 1,500, it'll be like $2,200. However, you can't. You can't get $2,200 at the 345 strike. You can only get 18. So there is a ton of value that the option holds on to for that last day. It's just if this 1,800 turns into 700 by Thursday next week, it's still going to have this $700 left in it, and $1,100 will have decayed out of that 8 days to expiration. And so it's just weird. Like theta is like 1.14, 8 days to expiration, and it's probably going to just increase slightly, 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 and then bam, you got 1 day left, and the frickin', theta rockets up to 3. So the weeklies have their own theta acceleration curve, just like the 45 days to expiration out of the monies have their own acceleration curve, and it's kind of slower, right? So 8 days to expiration. I mean, it's super. When I say it's slower, like that's only relative to 1 day left. Relative to 6 months out, like this, a dollar a day trading, decaying from this option contract is huge. But compared to 1 day's the expiration left, it's, a third of that. So I've considered a little bit of a strategy, not something that I would YOLO into, but I thought about just coming in here. And since I know theta is just out of its mind accelerating at 1 day's to expiration, I thought about just coming in here every Thursday and putting on a couple of extra positions just to try to capture this. Now that's super risky because the price could just rocket up to 375 overnight. Like that could easily happen. And so these could all turn out to be losers, which is, what the gamma risk is dealing with. Because at 3:59 p.m. tomorrow on Friday, if this is in the money, delta is 1. And every dollar that it goes above the strike price, the option's gonna go up a dollar. And it basically just turns into a binary a binary value at that point, because if it goes out of the money, then the option is completely worthless, and now delta doesn't change at all. It just goes to 0. And gamma is off the charts because delta is either going from 1 to 0. That's all it can do. If it's right at the money and it's going in the money, 5 minutes later it's out of the money, in the money, out of the money, delta's just ping-ponging around like a fucking pinball. And it's super hard to predict what the price is gonna be. It might be worth jack shit, or it might shoot up and be worth something. So farther out, delta, gamma, theta, these things are all kind of trending, and but at expiration, just weird things happen, and these values are not really to be trusted. But it does seem like taking theta acceleration to some logical extreme. There's like a ton of value built into this last little day of of expiration, right? I would have had to wait the whole last 5 days to get 1100 of this contract to drain out, and then just holding for the last one day, I can get the last 700. So why even carry it? Why even carry this contract for 4 of the 5 days when I can get more than half, like half of it in one day? Um, Options are just weird. So let me go ahead and place a trade. The main account, my theta, it was barely positive yesterday. And so as MicroStrategy's prices change, delta's changing, theta's changing, gamma's changing, all of these things are screwing with my daily theta that I'm collecting. And I'm not going to do anything too crazy because MicroStrategy is only up what from yesterday. I don't know, just a few percent, 3, 4%, something like that. So just for a little fun, not February. I'm just going to sell one covered call, and I'm just going to go right at the money. Nothing too crazy. If I get wrecked on this, it's not the end of the world. But let's see what that did to my net theta. It went from barely positive to 300 because 100% of that 700, how did I get paid? $700 has to decay in 12 trading hours. It's noon. So 4 o'clock is 4 hours. Another, 9:30 to 4 is only 7. Anyway, so 1.5 trading days, that $700 has to drain out of this account. So I can tinker with my daily theta, and it's like barely been positive the whole week, and I can kind of supercharge it on Thursday. There's no necessarily like this isn't like a proven technique or anything. I didn't get this out of Tasty Trade's playbook or anything. This is just kind of like fooling around and trying to recognize patterns that I see. Um, the IRA, this one, you know what? I'm gonna have to check. Let me do this in another. Let me pull up the app. You know what? I can. I think if I change privacy mode on the app, it's going to change it on the web browser too. So, yeah, I'll probably just have to update this. Be interesting to see if my leverage has come back, and just within a few days, my account was down like 25 grand, and I think MSTY was only down like 20 grand. So they definitely took the lead right out of the gate, but not really worried long term. All right, this is the joint account. My net theta is 20 bucks a day. It's very low probably for this account. Should probably be maybe three to five times higher than that. And it's because I have all of these long calls in the July 1080s. So there's a lot of positions that I don't have covered calls against. So nothing for me to do there, I don't think. All right, my allowance, again, I have a ton of speculation in this count. My theta is actually negative, and I'm okay with that because this is just all kind of fun money anyway. So I've got the one covered call on against my one December leaps, and I'm okay with that. This is the account that I'm trading against. Misty, positive theta is acceptable. I could I do have, so I've got the 6 poor men's covered calls on. Those are maxed out. Then I've got 300 shares. I've got one covered call against shares, and I could add 2 more. So maybe I will go ahead and run the same play and sell a 345. Let's try to get a fill. While that's trying to fill, I forgot to do something with my 700 bucks. And I've talked before about, if the price of MSTR is down, that might be a buying opportunity, so I'll buy leverage. And when the price is up, that might be an opportunity to sell calls, opening new covered calls or to close um, long calls. And so today's technically a green day, but you can kind of today's a green day, but this is a red week. So you could argue that I should buy shares because today's green, or you could argue that I should buy leverage because we're down for the week, but we're up for the month, we're up for 3 months, we're up year to date, we're up over a year. So that red day, green day thing it's kind of a feel. I mean, you can zoom out and probably get whatever answer you're looking for, but 300 bucks is not really enough to do much of anything with anyway. So I'm just going to buy 2 shares. That's definitely not going to pay for a move. Like if we have a move to 375 tomorrow, I'm going to make like 70 bucks off the shares. That's not going to cover the $3,000 that I would lose. So it's definitely not enough to pay if I get, wrecked to the upside by tomorrow. But it's a little something. All right, so in this account, I only just sold that one for 2 grand, or for 700, but I have $2,000 in cash somehow. I thought I spent it all. So, again, you can see my net theta went from pretty small to 300 with that one trade. So with 2,200 bucks, I can go and get another July. And 800 bucks, let's buy 2 more shares. Okay, cool. I'm broke again. I like it. Let's double check. 5K account. I got stuff expiring tomorrow. Again, it doesn't look like there's much value left in this Riot put. Only 6 cents left. So should I close it today? Not necessarily. So there's only 10% of its value left. So you could make an argument that I should just close this down today. But, 1% of the underlying price would be about 5, sorry, it'd be 11 cents. So this is 0.5% for one day. Prorated out for 5 days, that'd be like 2.5% for a weekly return. So it's not terrible. So I'm just gonna sit around. If this is worth a penny tomorrow, then I'll just close it. But you know, I could easily be convinced that closing this down today is also reasonable. But my 11.5 calls, these might get called away unless I roll them. 6.5 Wolf put will be assigned 100%. The CLSK put, I took that all the way out to February, so nothing to do but sit around and just wait for that one. Let me check the $500 call. I sold this for 13. It's worth, yeah, same. Yeah, nothing for me to do here. So let's check chats and then I'll start talking about the preferreds. What's up, David? Dude Face says it seems like the preferred would not have the volatility that we option sellers love. I agree. And I mean, we just had so much to talk about last night. I didn't even ask about whether the preferreds are going to have an options market. I assume the liquidity will suck because it's not going to be heavily traded, but I could be wrong. Anything that gives dividends is probably going to be a lower vol anyway. And I watched well, they showed it last night. There was a, what, maybe I wasn't paying attention, but I just watched the whole entire roadshow slide deck where Saylor talks about the preferred stocks. And I don't remember seeing the slide that Jeff showed. So I might have just been, my brain was just going all different directions, but it was showing the trajectory of MicroStrategy versus IBIT versus the preferred. And I think the preferred had even projected less vol and like a lower trajectory than IBIT even, but it's paying a dividend. So it's just super hard for me to figure out. But yeah, I agree with you. I don't think it's going to be an intriguing options play. Danny says, would you look at Cooler for a potential performance covered call with January 2026, $1 or 150 for the leap? Let me come back to that one. Ryan, wondering if you could share your opinion on 440 calls I bought that expire tomorrow. So you bought 440s. Yeah, my opinion is that I don't know how long ago you bought them. Let's see. Bought them 3 weeks ago. Should I have rolled these already? Should I still? Yeah, unfortunately, I wouldn't have even bought them with 3 to 4 weeks of expiration left on them because anything under a month and a half, under 60 days, really is prime option selling's territory. So all of the positions that I build The options that I purchase, uh, I buy options from an option seller's perspective, meaning as an option seller, I'm selling no 1 day to expiration. I just put on 2 one-day expiration, uh, covered calls. I've got 36 days to expiration that I put on 3 days ago. So, right when you were buying options, I'm selling the same thing that you're buying with very similar, strikes and expirations. It doesn't mean that I'm right and you're wrong. It just means that theta starts to accelerate under, 90 days. And so anything under 90, I start getting nervous about buying them. The leaps that I'm buying to sell covered calls against, I'm buying options 351 days. There's so much time to be right. And theta is tiny compared to the options value. Even my speculative um, options that I'm buying, 169 days to expiration that I bought 7 days ago, like even these 1080 strikes, like this is total lottery ticket shit. Like I'm not expecting the price to go to 1080 by July because I will roll these by April, May, June, July. Yeah. So I'm not going to let my long calls go under 90 days unless they're so deep in the money. Oh, of course. Unless they're so deep in the money that I just start using them as poor man's covered calls. So I would answer your question like, yes, I think the time to roll would have already been uh a while ago, but like I wouldn't have even I would have rolled mine before they even got as close to expiration as when you bought yours when you opened your trade in the first place. But let's just look at them. Expire tomorrow, and these are 440s. So how much value is left? Oh, yeah, there's nothing left. They're worth nothing. So, I mean, yeah, you can close these out for 5 or $10. Yeah, there's nothing to be done with these. Yeah, I can't give you any good advice because there really just isn't anything good here. You either take 99% of your losses and limp out with a couple of dollars, or you cross your fingers and hoping something amazing happens overnight, and neither one of those are appealing. Yeah, sorry I don't have anything better for you. Peter says, with an underwater weekly, would you consider rolling on a green day like today or wait? Meaning, I already sold it and then it went underwater. Um, when my strikes go underwater, I generally wait until the last minute. I don't want to roll them early. So it's not necessarily waiting for red or green. I basically just check and see how much extrinsic value is left in the option. So, like if I had sold the 330s yesterday and now it's in the money, I'm going to figure out the extrinsic value. And the way you figure out the extrinsic value is to figure out the intrinsic value and subtract that from the options price. The way that you figure out the intrinsic value of an in the money option, because only in the money options have intrinsic value, is you take the strike and subtract it from the share price. That leaves you with $10. The option is worth 14 bucks. So $14 minus the 10 leaves you with $4 worth of extrinsic value, meaning if you do nothing between today and tomorrow, you can collect that last little 400 bucks out of this before you pay the piper and have to pay the other 1,000 to roll. Now the price can go against you between now and tomorrow, and if the price goes up another $10, so now you're gonna have to pay $2,000 in intrinsic value to roll it, but you won't have to pay for any of the extrinsic value because at 359 tomorrow, the extrinsic value will be 0, and all you'll be left with is paying for the intrinsic value in that option. So when my strikes get threatened, I generally sit on my hands and do nothing until, the day before expiration at the earliest. And as long as I clean these up before noon tomorrow, Tasty Trade's pretty happy. I ended up like doing something and I didn't get to my options until like sometime after noon last Friday, and they did exercise one of my calls because I'm looking at my account and I'm like, why do I have $37,000 in cash in this account? And it's because I didn't manage my trades early enough on Friday morning, and they started getting antsy and they exercised my call at somewhere between noon and like 2 p.m. So in general, exercise is always a risk, but usually Thursday afternoon, Friday morning, unless it's super, super deep in the money, you can usually manage your trades before you get exercised on. But I slept a little bit and got caught last week. David says, I'm with you. Sold one at the money, 720. Nice. Fingers crossed. But at the same time, like I have so many uncovered positions. I mean, I hope the price goes to 550 by tomorrow. Like that would be fine, but probably not. Dude Face says on a red day, I like to roll at the same strike for a credit. A red day rolls. Okay. On a green day, I like to roll further out and raise the strike for a credit. Yeah, I agree with you on the red days. I think I'd do something similar. Green, it's kind of like I said before. If I've got a lot of time left, I don't like rolling and paying for the extrinsic value. I like selling calls and getting paid for extrinsic value. Now you're talking about rolling out and you're rolling out, so you're going to collect some more extrinsic value for adding more time. So that makes sense. Barqua says, "What to expect on February 5th earnings release?" I don't make any price predictions. You know, I'm bullish, so I'm long, and mechanically, I try to be short under 45 days to expiration, where I can collect the theta as quickly as possible. But that's a limited bullish strategy. Um, Covered calls is not a bearish strategy like some people think. But yeah, I don't know. Tesla pumped, not TLSA, TSLA. Tesla pumped, and I think the market may have caught a whiff of things to come because what was it, like 20%, 26% of their freaking profits in Q4 came from fair value accounting of their Bitcoin. And after hours yesterday, we had a little pump, right? We had a little pump to, yeah, to like 405 or something. And then on the open, it kind of crashed again. Not really crashed, but it just came back down. And so I'm wondering if the market is sniffing this out like, hey, wait a minute. If Tesla can offset their earnings with all this Bitcoin and MicroStrategy has a shitload of Bitcoin, like, are they going to figure it out? If the market figures this out, then we could get fireworks on the 5th. But if the market is still kind of clueless and still is not aware of what the hell's about to go down, then maybe we don't get the earnings surprise until Q1. Or if the market does start sniffing this out over the next 3 months, maybe we get the entire run up before Q1, and then we're anticipating this amazing earnings surprise. But, you know, if MSTR is sitting at frickin' 650, 750 a share or something crazy, February, March, April, May, at the beginning of May, I can't say like, "Oh, yeah, the price is 750 and we're gonna get an earnings surprise and it's gonna go to 1,500." Like, I would love for that to happen, but I'm not betting on it. I generally don't bet on any kind of short-term price action. Okay, so Danny says, asking about performance covered calls on Cooler because they're adding Bitcoin to their balance sheet. Cooler is so cheap. I'm not sure. A performance covered call is really necessary. I mean, I guess it's more capital efficient, so it could work out. But let me just talk about these stupid ass preferreds real quick. So I think they're a great product. I think they're going to be insanely successful. I think it's going to shut the ATM bears the fuck up. And someone replied on Jeff Park's thread yesterday that it might even be the end of the ATM in the MSTR market because it's so like it's extremely accretive to do it with the preferred market, and it almost benefits the preferred market. Like I put that the preferred stock is giving making me look like a confused German Shepherd because like I don't know if you've ever seen the videos of like like German Shepherd puppies when they get confused and they just turn their head and they got the doofy ear like and you're talking to them and they just like I don't understand what you're saying. That's kind of how I feel with the preferreds because let's say Bitcoin starts to pump, and let's say Strike is at $100 a share, MicroStrategy's, where it's at right now. Let's just say 350, and they both double. The preferred is at 200. MicroStrategy's at 700. The the Strike option becomes less desirable now because in order to get the $8 per share every, year, so $2 a quarter, you got to pay double for it. The people who paid 100 are getting the same dividend you're getting, but you're just paying twice as much for it. So it's going to be harder and harder for Strike to appreciate because at lower share prices, the dividend is much more exciting and it's much more of a benefit. But if you're paying $1,000 a share for Strike and getting this little piddly $8 per share, that's like 0.8% annual return. That's nothing. So every if people are bidding up the price of Strike, it's almost like the frickin' MNAV argument all over again. Like when MicroStrategy gets bid up and people say, "Oh, it's the MNAV is not justified." I mean, maybe it is or maybe it isn't, but I think there's a real concrete argument that the dividend part is very appealing at $100 a share, but much, much, much less appealing, an order of freaking magnitude less appealing at $1,000 a share. So it does seem like there's friction in this in the market for Strike. But not only that, if they if they're running the ATM in the Strike market instead of the MSTR market, now you're suppressing Strike's price, which makes it more appealing, which makes more people want to buy it because the dividend makes more sense. And you can just see that my brain is like a pinball, just knocked around all over the place because I'm trying to model out and just try to like figure out a few chess moves ahead. Like if the market does this, because we talked about the example that Jeff Bart gave also is like, let's just say that MicroStrategy's price did go to 1,000, or 1,500 even, let's say. Well, at that point, if you hold if you hold one share of Strike, you can, well, I'm sorry, 10 shares of Strike, you can trade that in for one share of MicroStrategy. Well, that would make sense if your strike price was 150 or less, but the conversion price is like a moving target. You're constantly chasing it. So every time you're a strike holder and you're thinking you're getting close to being able to convert because MSTR is pumping, but if strike pumps a little bit, then it doesn't make sense to convert. So you almost kind of like the strike shareholders can't complain about MicroStrategy using the ATM for strike shares because you win if the price of strike goes up and you win if the price of strike goes down. Because if the price if the price of strike if they don't sell at the ATM and the price of strike goes up, then that's cool because your freaking shares are more valuable. If the price of strike goes down and the price of MicroStrategy goes up, you still don't give a shit because you can just convert your strike to common stock if that ratio makes sense. So i- it's almost like a win-win situation for strike holders somehow, which I don't understand. There's got to be I can't quite figure out what the negatives are other than just as an option seller, like the 8% yield a year is meaningless to me. It doesn't excite me, but yeah, I'm just a confused puppy at this point because I'm trying to figure out how this is going to react. I'm assuming it's going to be loosely correlated to Bitcoin, like MicroStrategy is, but is it more correlated to MicroStrategy's price than Bitcoin's price? Or is it completely independent and the dividend just throws a damn monkey wrench in there? Um, like anything else, the price of the shares are going to be the combined buying and selling activity of all of the buyers and sellers in the market. So it might do whatever the hell it wants to do, completely uncorrelated to daily MSTR price movements. I'm uh, I'm excited to see what happens because right now it's me just trying to like go a couple of moves in the head of like, oh, if this does this, then that does that, and then I can't go more than 2 or 3 moves ahead when I just get too confused and can't, and can't deal anymore. So, That's enough preferred talk for me. I'm gonna go back and answer this question. So let's take a look at Cooler. Well, actually, let me just see if anybody commented on this preferred while I'm on the subject. Dude Face says preferred plus converts is going to make a very interesting cycle this round. I expect a blow off. I would assume that's a blow off top, but I wonder how if it will be dampened from preferred share offerings. Yeah, I think when they run out of, you know what, they've said that they've got a couple of billion of ATM left, but I wonder if the strike ATM counts towards the ATM side or the structured side. Um, I think I'm gonna have to ask the boys about that. Keith says, "Do we know when Strike will be available to buy in the market?" I do not know. Oh, Dudeface says it debuted on Fidelity today. Really? Uh, and Buffalo, I know you had asked, you had sent that screenshot that Fidelity wouldn't let you buy without 500 grand or something yesterday, and you were on the call last night, so I'm assuming you heard Ben saying that that was an error, and you can just call Fidelity and they will override that error for you. So I know you know, but everybody else may be wondering if they're opening Fidelity accounts and can't get that done. I think you do have to buy in like $25,000 chunks. And Buffalo says, I think Strike ATM will be under the fixed income side. That would be very cool. All right, cool. Let's go back up here and talk about. Let's look at Cooler. So Cooler is kind of appealing because it's only $2 a share. They put Bitcoin in the balance sheet, and I don't know if that's when they got this pump. I don't remember when they put it on, but let's just double check. If I'm running the wheel and I'm selling cash secured puts, okay, I can't get jack shit for tomorrow, which makes sense. And that's why it's so hard to trade stocks under $10 a share. I give a pass to the miners, like Wolf. I was selling puts at like $6 a share, but Cooler being $2 a share, it's much more difficult. So, selling covered calls, they're just worth nothing on the weeklies. So you probably have to go out to 45 days to expiration to even make it meaningful. Damn. And even at 43 days to expiration, the $2, I wonder if this is just because the liquidity sucks. Yeah. So there's a bunch of people asking 60 cents and like nobody bidding under that. So that's just bumfuggling the mid price here. There's no open interest. There's no volume. Um, but let me just see what I can get for the covered calls. So this covered calls at 43 days of expiration is the same way. I'm sure you can probably get a fill. So there's 20, and this might just be the market makers putting this out here. I don't know how many of these are actual people, but I'm sure you could find a price where you could get a fill. But again, there's no volume in here. The number one, it's either number one or number two, depending on how you look at it. But when you're trading, liquidity is the one of the top two metrics that you have to have. Position size is the other one. If the size of a position is so great that you can't handle the risk, then that's probably the number one thing to think about. But it's right behind it is liquidity. So I can't even, like, none of these strikes even have any volume. Let's do 36. Okay. So a month out, there's some interest here. There's a market here at 36 days. Okay, this we can work with this a little bit. Um Again, this is why I stopped trading iron because the bid ask spread was in increments of a nickel. And so it seems like I can get 6% return on capital here, right? 1% of 3 is zero point zero 0.03 times 6 is 18. So I can get 6% return on capital in 36 days. But if the only way that I can get a fill is at 15, now it's 5%. So an entire percent of my potential profits has been eroded just getting into this trade. So I don't know anything about Cooler. They could be the greatest thing next to sliced bread. But if I can't get in and out of trades, what are we even talking about here? And then a poor man's covered call is just going to make everything harder because I'm sure that you can buy shares. That's probably going to be fairly liquid, right? Yeah, the bid ask spread on shares is a penny. So that's fine. Buying shares is half the battle. Now you can sell covered calls against it. But trying to form a poor man's covered call going out here to, not quite a year, but instead of paying $200 for 100 shares, I can pay half of that, I suppose. Actually, really, you'd still have to be buying the $2 strike, which is basically the same as practically the share price. So I can buy the $2 strike for a little over half of the price of the stock. So there's a benefit to that, but there is a bid ask spread here. It's 15 cents wide on, it's about 10% of the options price. I mean, that's not like the worst I've ever seen, but on a cheap stock, it's not meaningless either. Um, so let's just go to the 36 days expiration again. All right. So suppose I got the 100 shares, or I buy that $2 strike out to frickin', what was it, 2026 for a little over a buck. And then I grab the $3 strike 36 days from now. I mean, that is kind of insane that there's 50% call away value here between the current share price and the $3 strike. So 50% call away value plus, I'm gonna assume I'm gonna get a fill here at 15 cents. So plus a 5% potential return over 6 weeks, 5 weeks, 5 weeks. That's 1% a week. I mean, I don't hate it as far as the numbers go. I just think that these dirt cheap stocks are very hard to trade. So a poor man's covered call would give you almost double the capital efficiency versus buying 200 shares. But I might do this. I mean, if I had a $500 account, I probably would. I would do something like this or Wolf. Maybe try to run the wheel with Wolf. But yeah, on our super, super small account, I guess this would be very enticing because all of the things that I've been complaining about when you got a $500 account, what else are you going to trade? You don't really have a lot of options. So I might try something like this if I had a super, super small account. Just be prepared. be prepared to just look for next week. Okay, so you can get was that 25% out of the money? Yeah, see, you can't even get a fill for 8 cents because you're gonna have to put in 5 cents to get a fill. There's 500 people lined up trying to get a fill at 10, so the weeklies are definitely no go. Like, it's doable, and it seems like it should be profitable, but, even the mining stocks are up and down and all over the place, and if Cooler goes back down to $1 a share or 50 cents a share, there's gonna be no options premium to speak of. It's gonna be insanely difficult. Well, actually, the 50 days are a little bit more active. But yeah, I mean, if the share price drops to $1 a share and you're just trying to squeeze a few pennies out, it's gonna be real hard. Um, but the premiums check out. I mean, it's a decent return on capital and it's pretty decent call away value. So all of that checks out. I just don't like the liquidity, and I think the risk of Cooler's price dropping and making it even less liquid and difficult to squeeze little premiums out of here, it's kind of an uphill battle. So I personally would only do this if I had to, meaning I had a super, super small account and this is like literally all I could afford, or I'm a first time option seller and, maybe I've got 10, 20 grand to play with, but I'm like, okay, I've been paper trading for a while, just sandbox trading. And this is something super, super cheap that I can learn the mechanics. And, I sell a cash secured put, or I buy 100 shares and I sell a call, and I'm managing that and I'm letting, the price goes up to 250. I let my shares get called away. If you want to learn how that feels with real money on the line, even though it's a small amount of money, it could be a nice way for new traders to learn how option selling works without putting so much money on the line that they just lay awake at night wondering if their shares are going to get called away or they're going to get wrecked. Um, I could see that this being a nice little tool for learning, but um, at the same time, I mean, if you had like 10,000 shares and you're getting, these small little profits would add up with large amounts of money. But if I had $20,000 or 50 grand to play with, I don't think I would be screwing around with a stock that's this cheap. I'd go find something at least $10 a share or more to mess around with, and not have to deal with these liquidity problems and penny stock problems. I got 99 problems, but a penny stock ain't one. So it's doable, I think, Danny, but I I won't be bothering. Key says, for what it's worth, I wrote calls for fun on Cooler, and it's hard to close them because volume is so low. Yeah, yeah. I think if and so here's the thing too, though. If you're selling something that's not too far away, you're kind of your get out of jail free card is that as long as if they're expiring out of the money, then the calls that you sold are just going to expire worthless. So liquidity kind of works in or can't work against you if you're willing to just let it expire worthless. that means that it's gonna suck because you can't manage it early and you can't roll it early, so you're gonna have to literally just sit there for the whole 45 days to expiration and wait. Um, Best case scenario, you would like to roll this every 2 to 3 weeks, buy it back for cheaper, roll it out for a credit, buy it back for cheaper, roll it out for a credit, and if the liquidity sucks, you're just gonna be stuck waiting for 5, 6, 7 weeks for it to expire worthless, because you can't find a buyer. Um, and the same way, the wheel still works as well if it goes in the money and your shares get called away. You just wait for expiration date, boom. The market has to exercise that contract and, pay you out for whatever strike. Like if you sold the 3, if you somehow got a fill for the 3, um, on March 14th, if the price is 350, doesn't matter how liquid or illiquid it is, because someone's going to exercise on somebody and the money will exchange hands. So I agree. I think what Keith is talking about, the liquidity is going to make it difficult to manage or roll your trades. But the trump card is you can just wait for it to expire. So, Dude Face says rum actually doesn't look half bad to attempt a poor man's call. What the hell is rum? Oh, Rumble. Um, Poor man's cover called the chain has weeklies. A leap out a year is for at the market is 490. Not too bad liquidity is a test run for those with less capital. Okay. Yeah, this is doable. The bid-ask spread is not ideal, and I don't see a lot of volume out here, but that's the 13.5 strike. Sometimes those have less liquidity. Eh, no volume, no open interest. It's probably better than cooler, but it's still not. Let me check 36 days. Yeah, there's a little bit of open interest here at 36 days, but no volume. So yeah, better than cooler. But let's look and see. Yeah, yeah, decent premiums here. But again, it looks like the bid-ask spread is in increments of nickels. Yeah, I do almost no fundamentals on any of the miners that I look at or any of these other stocks. This one was from right out of Sailor's deck. He was listing the top like most volatile stocks, and Palantir was in here. This is a this is a lot cheaper than MicroStrategy. Um, yeah, this is a little bit over like 1.25% for one trading day, prorated out for a week. Like this isn't terrible. Let's see. 1% of 80 is 0.8. 8 into 57. Sometimes, yeah, so that's like 7% for 7 trading days. It's pretty legit. Um, this is TradFi shit, and I think Palantir is part of the axis of evil, probably. I think they sell our information just for the government or something. Yeah, these fuckers will be part of Skynet when they try to take over human civilization. So, but yeah, I used to trade options on Palantir before I kind of fell in love with Tesla and MicroStrategy and Bitcoin derivatives. Uh, Keith talking about cooler. Yeah, I've been trying to close them for a week without taking a beating on the spread, but can't get filled. We'll likely just have to let them expire. Yeah. Yep. Dude Face says rum might be more interesting though, since they are only taking first steps into the Bitcoin space. Oh, okay. So they are okay. So Rumble, social media, right? So they haven't added Bitcoin to the balance sheet, but they're talking about it or they're announcing that they're going to. Is that what it is? Hmm. Dude Face says they have Tether invested, talks about a Bitcoin treasury, Bitcoin payments for creators. Okay, so that's very cool. So maybe we'll get another Bitcoin treasury company in the space. Matthias says PLT runs on government contracts. They do a lot of NSA, CIA, DoD, dark tech we're not allowed to hear about. Probably the hottest AI stock for software growth hopes. Yeah, I think back when I was selling it, so I started trading options in May of 2020, so way back here. And at some point, not, oh God, not Rumble, PLTR. Look at 5 years. So yeah, they came out. They came out not too long after I started trading options. But yeah, I was trading options on Palantir when it was 20, 11, down in here. And I remember people saying anything under $10 a share, they were just YOLOing into Palantir. And it's like they were correct. If you just held on to these sub $10 shares, that's a nice 7x. But let me just look at my history. It was the last trade I made on Palantir. So August of 2022, I sold the $10 calls. So my shares got called away. I must have had 500 shares of Palantir back then. Um, what was that? August of 2020? What was it? August of 22. Oh, I must have been running poor man's covered calls because in August of 22, I had the $10 calls that expire. Yeah, because this was a sell to close. So I had opened the $10 strikes. I don't know what the hell I was doing. Yeah, I'm assuming I had some poor man's covered calls going on. 8/31/22. 8/31/22. Yeah, I might have gotten wrecked on these if I was buying. Who knows? Anyway, long time ago. But yeah, back in the day, I would sell anything that had decent premium. And on my account size back here, I probably I probably was looking for these $10 stocks as well. So you can make money. Let me see what the liquidity is on Palantir. It's got to be pretty good. Oh yeah, shitload of volume, open interest, tight bid ask spread. I mean, this is tradable if you're willing to sell your soul to the government and government contractors. Matthias says extremely overpriced fundamentally, risky to sell puts this high, but definitely good premiums. Dude face says, yeah, ask Whitney Webb about Palantir. I'm sure. I'm sure she knows a little something. Matthias says I got called away playing the 20s and 30s, haven't had the stomach to buy back in. Yeah, that makes sense. And that's kind of my feeling on a lot of these. I'm completely agnostic about the mining stocks. If I was in Palantir and I made 10-20%, shit got called away, I'd be like, fine, that's fine. I don't have to own it. All right, later, Doofus. All right, I think we're all caught up. That was all the trading that I wanted to do. I wanted to talk about the weirdness with what happens to theta and option prices, under a week. Added one little position there, and once I'm offline, I'll check my Misty account, and I'll provide an update for that too. But I'm sure they're probably still kicking my ass. But it's only been a week. And then talked about the preferred and probably learned nothing. But at least you got to see me